So, Nick, these 5 reasons, if you can go through them fairly quickly, this is before you had these out before the latest news, which is, it doesn't really mean anything. It's symbolic. I mean, it means something to people that manage money, but all these things were your 5 reasons were already in effect before this.
Yeah, I mean, oil prices are clearly, moving back up, and they're near 4-year highs, and that's going to benefit GE's stake to 62.5% stake in Baker Hughes.
Yep.
And we expect that to continue to be now a source of outperformance rather than disappointment as it had been since maybe 2015.
Okay.
Clearly, we think that the company just visited them on Friday has got the resources in place to self-liquidate and fund all the liabilities down at GE Capital that are yet to be
Those are the regulatory and shareholder and bondholder lawsuit issues that you're talking about?
Yeah, WMC bondholders, they've reserved $400 million. They're, liquidating in line. They have $700 or $800 million of reserves for the wind down of the 40 to 45 billion of vendor financing portfolios. So you're going to end up with about $5 billion of excess cash when you're all said and done down at GE Capital, plus something called GCAS, the aircraft leasing business.
Okay.
The aviation, healthcare, and oil and gas businesses, as mentioned, are better than expected, and the aviation is much better. And then, of course, power this year and probably next year is less than expected. But these all wash out to, still allow the company to be in line with their guidance for EPS and free cash flow. We think will clearly now be better than the $6 or $7 billion that they've guided to this year versus the 5-6 last year.
Okay.
And then, I think that the company is well positioned to see its underfunded pension plan. $29 billion at the end of last year. 18 was contractual, and you'll see that reduced by about $12 billion, both from contributions as well as
the dividend safe, you think, because of the
dividend is safe.
Cash generation and asset sales likely to exceed
asset sales are going to come
billion.
through better than $20 billion, right? You're at 16, 17 today. You got $3.5 billion plus coming from distributed power. You got $1 billion from lighting. You got a few aviation product lines. I think you'll probably be closer to 21, 22 billion.
All right. So some people said that if it earns $1 a share, which you think $1 to $1.07 adjusted. If it's out of the Dow, it no longer deserves any premium multiple at all, and it could be a 10 times earnings. So they thought 10 was the low, but you don't think it goes there. You think it commands a multiple of what? Because it's still GE, obviously.
Yeah, I mean, this is trough earnings at a company that obviously is going through a lot of transformation across every aspect of its business. But, a very simplistic way would be free cash flow yield. And if you get a 5.5% free cash flow yield on $6 or $7, it's a $14 stock. On $10 billion, it's a $21 stock.
So, Nick, this is just looking in the rearview mirror, but I see people at this point doing this weird revisionist history. I'm not sure whether there's anything to it, and I've seen it posited that Immelt was left with a mess, and it took him as long as he was there just to clean it up to get it to where it is now from Welch. But all along we've been saying that it was left in real, that, or at least there is another narrative that it was left in pretty good shape, and that it was just, run into the ground over the last 15 years.
There's been serial capital misallocation here for a long time.
Since when?
Since 2004.
Okay, so that's after. Okay, so that's the.
And the other thing has been
buy high, sell low,
massive excessive
stuff,
investment that surged in 16 and 17 for GE Digital. That's been refocused. It was $1 billion cash use last year. It'll be break even in cash by 2019.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.